Hi everyone, in this video we'll be starting with the chapter number 19 of CMT level 2 about the VIX index. Before watching this video, make sure that you've checked the previous chapters. In case you haven't, you can check the description box below. So in this particular chapter, we'll be seeing how we use the VIX index. VIX index is basically the volatility index, and every single market has its own volatility index. For example, in India, the Indian market has India VIX, which is a volatility index, and similarly, the VIX index is present for all of the markets, including the US markets. So we'll be seeing how the VIX is impacted by the put call parity and the options supply, and we'll also see how does a VIX index basically indicate the market sentiment, and we will see the changes in a VIX as part of the market forecast, and we'll also see how to calculate expected 30-day movement of an index or a stock. Okay, so officially the name of the VIX index is the CBOE volatility index. So you might have seen the term CBOE volatility index. So that basically means that it's the VIX index. Okay, and it is basically, people say that the VIX index basically tells us about how much fear is there in the market or how much of greed is there in the market. Okay, so a more accurate description of what the VIX measures is the implied volatility that is being priced into the S&P 500 index options. So if you look at the VIX index during the COVID time, let me just quickly show that to you so you understand how you basically use the VIX index. Let's go on India VIX. Okay, so if you look at the India VIX and if I change the time frame to, let's say, 1 week, and if you just see this, okay, look at this particular spike over here. The volatility index was moreover stable over a long period of time, but the moment 2020 came into the picture, the volatility index basically showed a spike. So it was okay, and the moment it was 2020, the volatility went up. So that is showing how much of panic and greed is in the market and how much of fear is in the market. So when you see a big spike in the VIX index, you know that there is a lot of volatility in the market. And ever since again, it has just been stable somewhat as compared to this particular spike which was there. Before diving further into how the calculation that results in the VIX, this chapter will cover the history of exactly how this index was developed, followed by an overview of how the VIX is determined. Then, for the interested parties, there is more in-depth discussion of how the VIX is calculated. The VIX index has historically had an inverse relationship to the performance of S&P 500. Now, why are we saying that there has been an inverse relationship? Because when the VIX index rose that much, the stock market actually crashed, right? So that means that they do not have a direct relationship, they have an inverse relationship because the opposite was happening during that time. Okay, so yeah, there are a handful of VIX related indexes based on other equity indexes. The S&P 100 related VIX is calculated using the old method to maintain some continuity of the historical comparisons. Finally, there are also VIX indexes calculated on options based on the Nasdaq 100, Russell 2000, and Dow Jones Industrial Average. So there is a VIX index for each particular market and for using the each data, which is what I've been discussing so far. Okay. Now let's start with the history of VIX and why was VIX developed in the first place. So the concept behind the VIX was developed by Dr. Robert Valley of Vanderbilt University in 1993. So he basically published a paper and that was called as the derivatives in market volatility. So how do derivatives behave? How do the options and futures basically behave in terms of market volatility when there is a situation of market volatility? How do they basically respond to the same? So hedging tools long overdue, which appeared in the Journal of Derivatives, laid the groundwork for the index. The original VIX was based on pricing of S&P 100 options and used only 8 option contracts to determine a volatility measure. Obviously, that's not the same anymore. Now we use many more measures to create the VIX index, but this is talking about the first ever VIX index when it was developed, and OEX options were the most heavily traded options or the most active options during that period of time, which is why for this particular research they had used the OEX options. And the volatility index was based on limited number of options and was highly disconnected from the overall stock market due to the narrower focus of the S&P 100 versus the S&P 500. In 2023, just a second. Yeah. In 2003, there was a new methodology for calculation of the VIX index that was developed through work done by CBOE and Goldman Sachs. So, although the calculation was altered, the most important aspect to this change for individuals is that the underlying options changed from OEX options to S&P 500. Another significant change was an increase in the number of options that were used in the index calculation. Through a wider number of option contract prices feeding the formula to calculate the VIX, the true 30-day implied volatility level that is being projected on the S&P 500 by the option markets realized. So Goldman Sachs and just a second. Yeah, so Goldman Sachs and CBOE together created the original VIX index, and the formula was altered than what was created during the one which we saw during the OEX options. Okay, so what is S&P 500 and why did they use S&P 500 for the calculation? S&P 500 index is considered by professional investors to be the benchmark for the performance of the stock market in the United States. For example, we have Nifty 50 index in the Indian market, and that basically speaks about the behavior of the stocks, right? That basically talks about how the stock market or all the stocks in the market behave by just looking at how the Nifty 50 index behaves. So similarly, in the US market, the S&P 500 is known to be the key index or known to be the king index, which is basically used. The members of the index are 500 of the large domestic companies in the United States that meet criteria based on market capitalization, public float, financial viability, liquidity, type of company, and industry sector. So you can look at this particular table 19.1, which is given, that basically talks about what all sectors of stocks are basically used in the S&P 500. So we have various sectors like energy, financials, healthcare, industrial, consumer discretionary, consumer staples, and so on. And the weighting of the same is also given over here. You don't have to care about this, but just know that the biggest weightage is given to the IT sector or the information technology sector. Moving on, let's talk about the calculation of the VIX. So first, the VIX was introduced, like we have discussed earlier, right? The CBOE moved forward with the first exchange-listed volatility derivative instruments through the CBOE Futures Exchange. The CBOE introduced futures contracts based on the VIX. Other instruments have followed and more are in development. There are two ways to explain how the VIX is determined. First, it can be explained using simple non-mathematical terms. Then for those who are interested in an in-depth explanation and discussion of the formula and calculation, a more detailed overview will follow. Okay, so let's talk about the non-mathematical approach, which means this is an approach which does not involve statistics or which does not involve any sorts of mathematics in it. So the VIX indicator is of 30-day implied volatility determined through the S&P 500 index option prices. So if the question comes that how many days of implied volatility is used in the calculation of the VIX index, you need to know that it is the 30-day implied volatility. The option price used in the formula is actually the midpoint of the bid ask spread of relevant at and out of the money active options, which out of the money, in the money, at the money, you know these concepts because we have discussed in the options chapter. So you are going to use that, and the midpoint of the spread is more accurate price description than the last price of an option contract. So whatever prices the option contract has been taking during its course of time, you are going to take the midpoint of that price, and that is going to give you the most realistic and the most close by option value. So after doing this, you are basically going to a synthetic 30-day option is created, and the VIX is the implied volatility of the option. This results in the implied volatility of the synthetic option contract, and then the okay. So all you need to remember is that a 30-day implied volatility is used when you are calculating the VIX. Now let's look at the formula and the calculations which we are going to use. It is possible to trade the VIX with a cursory understanding of how the index is determined. Those who are satisfied with their understanding of the VIX and what it represents may skip ahead. However, readers who are more interested in how the VIX is calculated should be interested in the remainder of the section. So again, like they just stated, if you're not interested to know the calculation, you can skip, but it's always nice to go through it because you will have additional knowledge which you never know when might it be beneficial in your trading. The input For calculating the VIX index comes from all activity quoted S&P 500 index options for the next two standard option expirations that have at least 8 days remaining until expiration. Eliminating the nearer term expiration options that have only a week to expiration takes out some of the end of the contract volatility. So why are they taking out the option contracts which have very less time to expire, which means less than a week to expire? When option contracts have less time to expire, they have more volatility and they are being traded more, or people are closing out their positions, and situations like that cause extra volatility. So that is not a real volatility which you need to take into account when you are calculating the VIX index, which is why basically they have taken this into consideration, that we will not take the volatility of the options contracts, or we are not going to take option contracts which have less than 8 days or less than a week to expire. The option contracts from these two expiration series. Yeah, one sec. I was just saying something. Where were we? Okay. The option contracts from these two expiration series are the at and out of the money put and call options. All right, let's now come to the put call parity. We know what put call parity is, and we've discussed it in the options chapter as well. Now, let's move forward and relate the VIX index with the put call parity. Many traders and investors often ask why there appears to be an inverse relationship between the direction of the stock prices and the VIX index. So, this relationship may be broken down to the nature of purchasing options. When the market is under pressure, there is a net buying of put options. Clearly, if the market is under pressure and if the people are going down in situations like that, you buy more of put options because you are anticipating that the price is going to probably fall because the market is going to crash. That's what you're assuming, right? The rapid increase in the demand for put options pushes the implied volatility for both call and contracts higher. Now, we have discussed in the implied volatility chapter as to why the both put and call options, both of them price increases. Why does that happen? That happens because of the put call parity. We've studied about that when there is a demand, then it increases for both of them, right? And where do you make profit? You make profit in the cases that the one which you expected the price will increase. Let's say you expected for the call price to increase. We know put call both might increase, but the one which has a higher magnitude to of increasing, that will give you money. Okay, even though we do know what put call parity is, we'll still just go through it. Put call parity states that the prices of put and call options that have the same strike price and expiration are related. The relationship exists due to the ability to create synthetic positions in one option through combining the other option with the underlying stock. With this possibility, if the price of one option differs enough from the price of other, an arbitrage opportunity may present itself. For instance, in a zero interest rate environment, a put and call option should have the same value if the stock is trading at the strike price. As the options are related in the price, the implied volatility of these options is also related. Arbitrage, we know what arbitrage is. Arbitrage is taking the advantage of the difference between the two prices. I'm not going through it, but I hope you know these payoffs since we've discussed it in the previous chapter. Okay, let's continue with the VIX and the market movement. What is VIX and the market movement? The VIX is a measure of the 30-day implied volatility as indicated by the pricing of S&P 500 index options. The VIX is expressed as an annualized volatility measures, but it may be actually used to determine shorter term market price movements. Recall the example with Amazon reported earnings. The implied volatility of the at the money options that only had a day left to expire could be used to determine the magnitude of movement which is expected from Amazon stock the day after the company's earnings release, right? If you look at the IV, you know that IV is usually spiked before a big news announcement or a big earnings report which might come, right? So you can look at that and you can find out the implied volatility. How do you basically calculate a 30-day market movement? The formula for determining expected 30-day market movement is VIX divided by square root of 12. So 30-day movement is basically VIX divided by square root of 12. Okay. So if there is an MCQ which says what is the formula of calculating the 30-day expected market movement, you are just coming up with the formula VIX divided by the square root of 12. Okay. So that's the formula, and the answer is going to be probably in percentage. Okay. Now let's come to this particular part. Equity market volatility index. In addition to an index based on S&P 500 volatility, the CBOE has developed a handful of other volatility measures based on other common stock market indexes. We have CBOE DJA volatility index. The CBOE DJA volatility index is calculated in similar fashion as the VIX index. Okay, so this is also another volatility index which is calculated just like that, but the only difference here is that the underlying is different. CBOE volatility index gives you the volatility of SPX. For DGIA, DGX, NDX, RUT, OEX, QQQ. So you can see that these are the underlying, and these indexes basically tell you about the volatility which is occurring in these particular indexes. Okay, so now in this table you can see all of these stocks are comprised inside the Dow Jones. So the Dow Jones index has all of these stocks. So the CBOE index basically will give you the volatility which is present in this entire particular um, stocks, because this is what is comprised inside of the CBOE instead of the Dow Jones index. And again, for if you want to see the Dow Jones weightage, you can see that. And again, one thing to keep in mind that in the Dow Jones index, industrials are given the highest weight, and in the S&P 500, IT was given the highest weight. Okay. Now let's come and talk about what is the CBOE Nasdaq Volatility Index. Here again, this is going to tell you about the volatility of the Nasdaq index, right? So it talks about the Nasdaq 100 stocks, and it talks about what kind of volatility is present in the stocks which are inside of the Nasdaq 100. You can also see this Nasdaq. This is the weightage in the Nasdaq, and what is the highest what sector comprises the highest amount in the Nasdaq index? It is the technology. So we saw that in the Nasdaq, technology has the highest one, in Dow Jones Industrial has the highest, and in S&P 500 IT has the highest. Okay, now we have the CBOE Russell 2000 volatility index. So what is Russell 2000? In the US, Russell 2000 is basically an index which is composed of 2000 smallest companies that are there in the Russell 3000 index. Okay, so the smallest companies which are there in the Russell 3000 index, that basically is in the Russell 2000 index, and this basically the Russell 2000 volatility index basically talks about the volatility which is there in that particular index. And again, implied volatility of 30 days is taken into account when you are creating a volatility index. Okay, and then we have the CBOE S&P 100 volatility index. This one basically has the S&P 100 instead of the S&P 500, and it gives you this particular um, index. One thing to keep in mind is that OEX basically represents 100 of the largest companies. Okay, so that's what every single index has a different criteria on basis of which they have the stocks. You can see S&P 100 here. The highest weightage is taken by IT again, and similarly IT in the previous one. Now let's talk about the AMX QQQ volatility index. AMX QQQ volatility index is another measure of implied volatility on the Nasdaq market, but the only difference here is that it is similar to the original volatility in the calculation for VXO, but the index indicates the forward-looking volatility based on option prices. To get through true option contract, the midpoint is used into calculation. Okay, so in the AMX QQQ volatility, the midpoint of the option prices is taken into account. Okay, and the CBOE CFE currently trade in options and futures in the VIX index. However, this alternate VIX index may be used to gain insight into market volatility, but the AMEX is a very better measure to check the volatility, because here they use the midpoint when they're calculating. So that's it with this particular chapter. Make sure that you check the other videos, and make sure that you drop down your comment, your questions in the comment section. I'll try to answer them. And if you are still confused with this payout payoff graph, then you can ask me, then I'll probably make another video and I'll explain this. The only reason why I did not explain this particular thing is that I've discussed the exact same particular example in the previous chapter, so make sure that you check that out.